Fantastic. Okay, cool. It looks like I'm now live. I'm glad I did not get started before I checked it out and confirmed, but it looks like I am live. It looks like we're in here. Fantastic. Okay, cool. I'm really excited. Today we're going to dive into one, and this is going to be really just conversational, educational. I want to be able to help with it. I've put this together, and I'm going to continue to do more of these. So I'm very excited about this for you guys. I have my audio on. I can hear myself. All right. Turn that off. Sheesh. All right. Cool. So this is going to be like, please ask questions if you guys have, because we're going to be diving into some really complex things, but it's really cool because we're going to be talking about why like everybody's launching funds now, right? Like it's not just Wall Street suits, people in a suit, people like whenever I thought of funds, and I don't know, you guys don't know me, maybe you do, but when I always thought about funds or investment funds or hedge funds, I thought it was some like really far-fetched, like this crazy idea of things that you can't accomplish, you can't get to, right? Like it's something in the ether that wow, you had to go to Ivy League school to accomplish. And then as I started to dive in, I realized well, it's not like that at all. Actually, it's far easier than you think to dive in, start a fund, and be able to scale. And think about it, like people like Logan Paul just launched a venture fund. Kim Kardashian just launched a private equity firm. Alex Hermosi built, I mean, just literally had $130 million book launch. And what he was doing before that, and what he mostly does is he has acquisition.com where he buys businesses. And I don't even know if a lot of you guys know this, but what he does is he everything he uses, he goes, hey, here's my book, here's this for free. I want you to build a business big enough for me to buy. And because we've created so much trust, because we've created this whole like ecosystem of trust and authority, then you're going to come to me and I'm going to buy your company because you've already implemented all of the things that I've taught. So then he works at economy of scale at that point. So he's like, you've implemented everything I've taught. Now I no longer have to go and implement all of that stuff in your business because you've already done it. And so that's his funnel. Right? And then you have like Pace Morby, who's going out and syndicating RV parks, or he's actually starting a fund. And then, of course, like Cody Sanchez, this is her big thing: buy up small regular businesses, buy up the things that the mom and pop shops, the laundry mats, all of that stuff. Like that's her thing. Now, what's really interesting is those at the top. So this is like one of my favorite graphs. I'm going to show this to you guys because this is like this is what's really wild to me is that literally the top 50, and I'll show you guys right here. Let me just where am I? Here we go. Perfect. All right, share screen. All right. So literally the okay, cool. Literally the richest people in the world, right? The richest people in the world are fund managers. So out of like the Fortune 500, they have who are, and this is 2023, but out of all the billionaires in the world, the top 15, like 15% right here are fund managers. And then you have like I think another 10, 15, well, 7% real estate. So if you're a real estate investor, you have a 21% chance of being a billionaire. But this is the thing that blows my mind. I always joke, I always tell people this. I go, hey, do you guys know who David Tepper is? And if you live in Charlotte, you do know. David Tepper is the guy that bought the Panthers, bought the Charlotte FC football team. David Tepper in 2018 bought the Panthers for $2.8 billion. Well, last year, so even just to be a little bit more updated than this, actually, no, right here, look, David Tepper bought the Panthers for 2.8 billion, actually last year. So in 2024, he took home $3.1 billion. Take home. I'm not talking about like net worth. I'm talking about what he actually took home in his bank account. In 1 year, he could have bought the Carolina Panthers. And even like Ken Griffin, who owns and runs Citadel, Ken Griffin is building the biggest house in the world in, I think, like Palm Beach, Florida. It's going to cost $1 billion. Ken Griffin last year made $4.1 billion take home. That is $1 billion a quarter. That means in 3 months, right? Like in 3 months, he he made his house. That's incredible. That's crazy. That's insane. And so you just think like being a fund manager is the most lucrative thing you can do in all of business. And so you see, like for decades, the wealthy have known something most people haven't. Owning a fund is the highest leverage wealth vehicle on earth. Period. Not even close. Full stop. One, it's and I equate it and I talk about it like this. Like if you're in real estate, then you know this too. I'm not like clowning all the real estate agents, but it's like agents. right? And then you have like wholesalers. I like to put wholesalers above agents. Agents, and then you've got wholesalers. And then above that, you got flippers. Because then now the flippers are doing, and this is also in Ravikant's book, which is so fantastic. You guys got to go and read it. But he talks about this, right? The level of responsibility goes up, but also your pay goes up. Because like if you're just a contractor, then like you don't have a lot of responsibility, but you're also not getting paid the most. But the next level you go up is like if you're the flipper, then you have more responsibility. You're the one that's doing that, but you also make the most when you go and sell it. But let's say you're a developer. Now you're at millions, right? You're at millions, but you have the highest risk and you have the highest responsibility of all the people that are actually building, because you're building multiple things. You're building a community, you're building whatever, but you make significantly more money. And then above that, the bank, right? So then you have the lender on that. Now, what's above a bank? What's above a lender? A fund. Because what ends up happening there is, and I don't know if you guys know this, but of course, like BlackRock, Vanguard, KKR, all these big companies, they're the ones that actually give money to, like, what's even funny is like a lot of people in real estate know of like Amherst or Progress Residential or some of those really big funds. Who's giving them money? The people that give them money are like Vanguard and BlackRock. That's who's giving Amherst money. And so there's really levels to this. And the top, I say the pinnacle of business is funds. The funds are at the pinnacle of the business, because what then ends up happening is you're able to go and leverage. It puts you in control of money. And as you guys know, the golden rule, he who holds the gold makes the rules. And so it puts you in control of the money, the decision making, and the equity, but also the upside, the massive upside of controlling all of that. And here's the good news, though, that I'm really excited about. It's no longer just billionaires in blue suits that do this. The game has changed. And that's why you're here. So thank you for being here. I know that was a little bit of like an on-ramp to what we're going to be talking about here. So thank you for being here. I'm excited to kind of dive in, because I'm going to walk you guys through how we can raise capital today in this day and age, and be able to launch investment funds using AI, because I am super bullish and do a ton with AI. So I'm going to walk you guys through a ton of different things in here. I've been putting this together, so like bear with me a little bit, but let me see. This is kind of the app that I'm using. Is there like a present mode? Oh, there is. There is indeed a present mode. Okay, so we're gonna walk through a lot of this stuff, because this is the model in which I use. Is like as we launch and run and scale funds, all of them are based off of this model: the design, build, raise, and launch model. So we're gonna really dive in exactly how you guys can do that, like how you guys can straight up learn how to do this, and then how I'm integrating AI into all of this. Because how I started was I used my own money. I think a lot of us use our own money. Then I started using other people's money. And then one deal at a time, I started going. Then I got into, like you could get into a syndication, which we'll talk about that a little bit, right? Like a syndication right here. A syndication is like one deal at a time. Maybe it's an apartment complex. Maybe it's a self-storage unit. Maybe it's like a build and you're getting multiple people on it. Like that's what a syndication is where you bring people together, you pull that money together for that one specific deal. Because otherwise, and this is extremely important for you guys to know, otherwise, if you guys are pulling money together, then you probably are operating within a security, which then makes you liable to the Security and Exchange Commission, the SEC. And so you really want to make sure that you guys are compliant in that. And I can't tell you, I've been in all the masterminds. I pay $30,000 a year to be in a mastermind. And I can't tell you how many conversations I have with people, and they're like, oh yeah, I have this person and this person lending on a deal. And I'm like, cool. And then, they start getting into like 3 people, and they're like, oh, they just wire me money. And I'm like, whoa, 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 security. Like, be very careful. You're operating dangerously close to like securities. And so then they're like, oh, ha, 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 ha. Well, then we just have them like wire the money into escrow, security, prison. Like, not a joke at all. I'm not joking. I tell people, don't ever play around with like the 3-letter entities, right? The IRS, the SEC, the FBI. Like, don't play around with them. They don't joke. IRS don't joke about his money. SEC doesn't joke about securities. So like, just stop. And so even if you got to spend money now to like form a syndication for that deal or launch a fund for that deal, like, do it. It just makes sense. Or fund to fund, whatever, do it. It beats going to jail. So eventually I realized that the ultimate structure for me to scale, for credibility, for consistency, was to be able to launch a fund. And if you're here, then I bet that you feel that too. You've done deals, you've proven yourself, you've got a track record, but you want to take it to the next level. The system that gives you the most leverage as possible to be able to maximize the skills and ability. What the heck was that noise? Oh, sorry. I have this app that like times everything I do, and it just told me I should take a break. Anyways, so the system that gives you the most leverage as possible. So what if you could launch your own investment fund and raise like your first $500,000, $5 million without needing a finance degree, Wall Street degree, like connections, or paying 50K for a law firm before you even know if you have interest? That's a really big part. So I started my fund. I've gotten to a couple now and all these things. And I started funds and I've learned a lot. My first fund did not go as well as I'd hoped it would go, but couldn't control the market and a lot of that stuff. But as long as you over communicate and things like that, people understand. But I launched my first fund, raised my first 2 million in 6 months, from going from like 2 private investors to 40 in my first fund in 6 months, raising capital for that, launching that, deploying it, scaling that fund. Did that. And then now I continue to help launch other funds for other people. So my partner in this, Seth, he's a SEC attorney. He's launched almost 1,000 funds at this point. I think he's getting really close to 1,000 funds for other people, which is really cool. And so we talk about this stuff all the time. So if you're a real estate investor and a business buyer, or someone who's hustling one deal at a time, someone who has a really good thesis on stocks or anything like that, wants to scale that up with other people's money, or somebody who wants to get into a crypto fund or Bitcoin treasury or whatever, like, you're in the right place. And this is live, so please ask your questions. Let me actually go over to the thing. Nobody's asked questions. There's 4 people here. Thank you for being here. I appreciate you. And so why does this matter? Like, why does this matter? Let me actually just dive in. Thank you guys for being here. Let's freaking dive in. Actually, I do want to talk about a little bit about, like, there's like a couple things that I really want to talk about. One of the biggest things for me, so if you don't know, I'm Black and Middle Eastern. I joke, I say, like, it's the 2 worst things you can be in America. I am least likely to be able to go and launch a fund. Let me tell you exactly why. One, I grew up in LA, single mom. I say true triple double mom, 3 jobs, 2 kids, worked really hard to make sure that we got the life that we could get, that she worked really, really hard for. And I'm like sharing nothing. Give me a second. Worked really, really hard for, really, really. And then went to college, blah, blah, and then learned how to launch my own fund. But like, here's the discrepancy here. There is $82 trillion worth of assets under management in the United States. 82 trillion invested into like private equity, invested into hedge funds, invested into real estate in the United States currently. Only 1.4% of that is managed by minorities and women. So that means that 98.6% of all money in America currently invested into America, invested into the infrastructure and the progress of America, is managed by white men. And so my goal, one, is, like I always say this, diversify Wall Street. That is a really big deal for me, to be able to make sure that everybody, right? I think that the world equally distributes talent, but doesn't equally distribute opportunity. So there are so many people out there that are significantly more talented than me, significantly smarter than me, but don't have the same opportunity. And so I want to bridge the gap between access to knowledge and information and capital, and minorities, women, and even the rest of the world. If you're white, you're here, fantastic. I want to help you to be able to get there. And so we all come from this grind, but we're in a capital game. And those who know how to structure capital and raise it, they run the whole board. Like, they're winning right now. And this is why it matters, because there are people who have money and have no idea how to deploy it. And there are people like you, smart, experienced, hungry, with deals and no access to get into that room. And so, like, that's why I'm here, to flip that dynamic. That's why I'm here, because, like, there's a couple of false beliefs that you guys are like chopping up in your head right now. And one of them probably is that you need a track record. I think I have this written down somewhere. Give me a second. First of all, I'm going to show you guys Gamma. Gamma is like, it's part of the thing here. It's like the best thing for, yeah, here we go. That's funny. I have this in a presentation, so let me just show it to you guys. Gamma is like the best for creating slideshows or things like that for raising capital. So I'll show you guys a little bit later. All right, here we go. Screen. Cool. So, like, you guys are probably thinking of like a couple things, right? The one belief is like, I need a track record, right? Like, I need a track record or a Wall Street resume to launch a fund. This is not always the case. Like, I know some people who have launched, and we've helped people who have launched funds around mobile home parks with no Wall Street resume just results in a story. Like managing millions, being able to do that because they had a story. They had that track record of knowing how to do things. And one, I would say, like, you just have to have the conviction and knowing, like, I've done this before. I can do it at scale. And so you need a simple structure, a clear offering, and real opportunity. Believe too. I need 30K for a lawyer before I can raise. So here's the really interesting part. We're going to dive in just a minute on like the whole structure of it. I don't know if you guys know this, but to like start a syndication, it's probably like $8,000 to $15,000 in just legal fees to start a syndication. If you want to start a fund, depending on how complex it is, it's going to cost you anywhere between like 18 on the lowest end, 15 to 18 on the lowest end to like 80. I've seen people spend $80,000 on their documents just for the legal fees, just to talk to an attorney and have that attorney put together legal fees for them. It's insane. That's backwards. You can validate your idea, which is what we're going to talk about. Validate your idea, have a few investor conversations, get soft commitments, and then go and pay the lawyer or whatever. Like, we're going to talk about structuring all of that. Like we talk about in our program, raise before you launch, right? Like understand that this approach is so important so that you don't go and waste money. And then you go and you pay the money that you know that you're going to have soft commitments. And then another false belief is this. I don't know how to talk to investors legally. Now, we're going to talk about today, hopefully we get there, my first fund framework, just this idea of like how to engage people, how to have that conversation, how to start raising capital from them. So we're going to dive in, and then how I use like AI to do it at scale, because there's a lot of really huge things that like we get in our own way and we don't need to. We could be able to use AI to be able to do that. And so here's what usually happens. Someone gets excited, hears about a fund, and then the first thing they do is they call a lawyer. They drop 15K, 20K, even 40K on docs, and they haven't even validated their idea yet. They haven't even like sure they've talked to a couple people, but they don't even know if that's going to work. If investors are going to want it, they don't know if the model even makes sense. And so others, they try to bootstrap a fund structure on top of a syndication, like habits, things that you do. It's funny. I talk about like when I get private lenders on fix and flips, those are like mini syndications and use promissory notes instead of full fund docs. And so we take that and then we go, well, you know what? I can just chat GPT PPM docs. Full disclosure, that's actually what I tried to do in the beginning. I tried to chat GPT my PPM docs. Do not do this. This is not financial. This is not legal advice. I'm not an attorney. I do not pretend to be an attorney. I do not play an attorney on television. Like none of those things. But so do not do that though. I tried to go and like have ChatGPT put together my PPM, and I really like went through it and really used like a template PPM and had it build up on it. And then I took it to an attorney and they were like, what the heck is this? And so I ended up spending way more money because I did that. So other people try to bootstrap it, and this may be one of the biggest ones. You don't understand how to raise capital the right way. You think that you need a pitch deck and a prayer, right? Like, but real capital raising is an invitation, not a pitch. And so we're going to talk about that. We're going to talk about exactly how we invite people in. So let's like dive into this. Let's do this. Where am I diving into? Where's my stuff? Here it is. Fantastic. All right. We're going to share this instead. We're going to dive in. So we're going to go through the design, build, raise, launch. So if you're taking notes, if you have a pen and paper, this is where you want to start writing things down. I'm going to try to pull up the chat in here. Just so actually, maybe I'm just going to pull up YouTube and then mute myself on YouTube so that I can see what's going on in the chat, because I want to make sure that I'm answering any of your questions. If you have them, please ask questions. This is 100% like for you guys. So I don't see any questions in the chat, and that's okay. So let's go ahead and talk about design. So this, and let me talk about each of these first real quick. So how you launch a fund is you want to think through your ideal. We want to design our ideal. We want to design what we're going to do. This is going to be based on our thesis, all those things. And then we want to structure that deal. We want to structure it correctly according to like, how will people get paid? How is that going to work as far as like, you can go to them and go, hey, this is what you can expect from me. This is what type of fund we are. These are the, and this is what the offering is. And then you want to pitch those investors. So we're going to talk about how exactly do you pitch them? What does that look like? How are you going to raise millions of dollars? And it's a lot easier than you think. There's over I love this. There's over, I think, $7 trillion in IRAs right now, and 401ks, IRAs. 2% of that is just sitting and able to be self-directed. And so you can have those conversations of like, hey, let's move your money because this is an old 401k that you had, move it into a self-directed vehicle to be able to invest into my fund. Like you can have conversations through education and things like that. And then we're going to talk about getting your docs. So let's design it. When it comes down to it, you guys have to figure out what's your edge, right? We want to talk about like, why is somebody going to invest into you? And we'll break this down into a couple of things here. But why is somebody going to invest into you? A lot of times, this is going to be your strength, right? So there's three types of people in a fund. And so I have this on your team here. You have the fund manager, and this is what creates the GP, which is your general partnership. Typically, a fund works like this. You've got a GP. Oh, my pad is upside down. Typically, a fund works like this. You've got a GP and you've got an LP, and those are the models that those are the models that most funds deal with. And now, where is my thing here? Okay, here we go. You've got LPs and GPs. LP stands for limited partnership, which this is how most models. Let's say like you decided to set something up as an LLC, which I don't suggest, right? Like I don't suggest you try to set up your fund as an LLC. But let's say you tried to, how do I change the thickness of this thing? Pin, thickness. Here we go. So let's say you can set up your fund as an LLC, but if you do that, what ends up happening is all your investors, they then end up becoming owners in this LLC with you. You don't want that. You don't want an investor to be an owner in an LLC with you, because then what ends up happening is they have they now you now open up exposure for them to be able to make decisions or vote you out or things like that. In this model, in most fund models, you have LP and GP relationships. The good thing and what protects your investors in there is that they are limited, right? So like they are limited to whatever their exposure is limited to whatever happens in the fund. So let's say the fund gets sued, their exposure is not personal. Their exposure is only limited to the amount that they have in the fund. So GP, and they can't vote you out. They can't make those decisions. They are limited. This is a limited partnership. So you run a GP LP structure, and typically there are three people. You have a fund manager who runs a lot of the compliance, the accounting, the investor relationships, things like that. Let me make sure you guys can see this. You've got the fund manager. You've got the capital raiser, which if you guys have raised capital, this is a full-time job in itself. But you've got the capital raiser. But here's a lot of your differentiator right here. Your differentiator is going to be a lot of your operator. Your operator is the one that's going to help you to essentially find what is your innovation or differentiator, right? So that means that you could have figured out some kind of crazy algorithm for trading. That could mean that you have, like that you're the one that goes out, finds the deal, and then begins, and then runs that deal. So you run the property management, or you're out there finding the people that are, getting the houses at discounts. So for instance, when I had my first fund, it was, hey, we get houses at massive discounts and we can flip and renovate those. So now the market was crazy, and so that kind of messed with us. So you do have to make sure that, right, like you've got track record and you've got contingencies that help to mitigate risk, because people are like, well, this is my money, this is my livelihood, depending on who you're raising from. Some people are going to say this is my livelihood, some people aren't. But we'll talk about that a little bit. But like the operator side of that is where you're really going to find a lot of that differentiator side of things. That is your strength. That is the strength in which you in which your thesis is built off of. And that is where you're going to be driving the most, what's called alpha, right? The alpha is the difference between the what the market is returning and what you can return. And you want to drive the most alpha possible for your investors. Otherwise, they're going to say, well, why don't I just put it into a bond and make 4% backed by the US government? Like, I'd be fine with doing that. And you go, well, that's not the best. Here's why, and here's why we drive the most alpha. Or they go, oh, I could just stick it in the stock market, the S&P 500, and then build at 8% a year. Sure, but then also you lose the opportunity to be able to participate in what we're doing here. And so this is where your asset class, right? So like you've got specific asset classes that, let me try to make sure I use this thing. Asset classes that you use, how good your skill, your track record is. That is what gives you your differentiator. That's what gives you the edge, right? The edge in running and launching funds. Now, some of you know what that is. Maybe you're a builder. Maybe you're like a flipper. Maybe you're developing. Maybe you're going out and you're able to identify. You want to, instead of having one syndication for your for your mobile home park. Maybe you're like, I've got so many deals people are bringing me. I want to make sure that I can capitalize on them when they come instead of having to stop, raise, and then go do that. But then what also ends up happening is, let's say you put an offer on, right? And somebody puts an offer, let's just say it's on a mobile home park. It costs 1.2 million. And so they want 1.2 million. And then you go, great. Let me give you my LOI. I need 3 months. I'm going to go ahead and raise that 1.3 million. But let's say you have and then they go, okay, cool. Or let's say you have a competitor, or you, right? We can just interchange the two. A competitor who says, you know what? Instead, I actually already have, so you've got the 1.2 million, but you need 6 months to close, right? Or somebody comes in, and this is why like Amherst will come in and they'll get the discount before you, because they go, well, you know what? I'll give you 900K in 2 weeks. Because they're liquid, right? Because they have this fund that they've been able to launch and scale and then grow, and they are sitting on that capital because it's sitting, right? They don't have to go out and raise capital for the 1.2. They've got 900 ready, and somebody's going to go, well, 6 months, 2 weeks, I'm done. I want to get out of here. Let's go with that one. So then now you want to come up with, right? Like as we're designing here, we want to come up with, what is our thesis then? Are we buying self-storage units in the southeast of the United States that are at 6 caps and above, like, or 9 cap, whatever? Or are we value add multifamily in, like in Atlanta, Georgia? Like, what is your thesis? So this is what makes it really good. This is what's good about, as I like to talk about, like this is good. The best thing between like a syndication and a fund. Right? A syndication is going to be one asset, and that asset is already established. It is this, it is this. We're going to come in, we're going to value add it, blah. And then when you have a fund, though, you could say, hey, this is my track record, and we're going to buy all 50 to 75 units in the Southeast US, right? Like we're going to buy all that, or we're going to buy, I don't know, like, maybe you're state specific. I know states like North Carolina, South Carolina, Indiana, Ohio, very, very popular for lower price point, high rental markets. So you can come in here and say, hey, we're going to buy everything between 150K to 175K, and it's going to be cash flowing 500 a month. And we're going to buy every single house that we can get in that price range. And you're going to go raise capital for that. And then your distribution's working that. But your thesis is that. What is the model that you're going to be running? How are you going to be doing that? So you got to establish, what's that thesis? What's the model? What's the thing that makes you different? And you're going to bring those in together. And then who's on your team? Who's on your team? Who is going to be the people that, like, how do you have the credibility on your team? Now, there's a lot of times where you're going to want to go, I can do this by myself. I strongly suggest against it. Strongly. So you always want to find somebody that can be able to bear the burden. This is a beast. Running a fund is not like an easy thing to do, but it's worth it, depending on your size. But you should always have multiple people, because you're going to run across instances in which you have, somebody's going to have to make sure that, wow, what was that? I don't even know that was either. Wait a second. Is that how that goes? There it is. So you're going to have somebody that has to run compliance on this, where this person is going to be making sure that, like, this is person one, and they're going to be making sure that when tax season comes around, that you have a fund accountant and you have maybe like an LLC level accountant, or a operations level LLC accountant that makes sure all that stuff gets passed through, because now you're worried about depreciation and profits. And so making sure the distributions are getting taken care of, making sure that compliance is being managed. If there's accredited investors or non-accredited investors coming into your fund, that you are managing those accredited investors. Okay, still no questions. Cool. I'm just making sure, because I'm here for you if you got them. So your fund manager is just making sure. Now, there's a lot of things that you could use that help to make this process a lot smoother, but you want to have somebody that manages that. And then you want to have an operator that's taking care of the deal, responsible for the deal. Sure, they bring in information for everybody to talk about, but wants to make sure that the deal goes as smooth as possible. Otherwise, it gets really tough. It gets really tough to have to be taking care of all of these different things, making sure operations are going, and raising capital. Like raising capital is a full-time job. You are at meetings, you are at locations, you are at places, making sure that everything is getting done correctly. Having like sending out newsletters, sending out the docs, all of these things for them to sign. All of these things happen right in here. You want to make sure that you have different people managing these. And so it's great. It's a very good thing. And I often think about like, somebody said this the other day. Actually, I can't remember what they said, but they said like, just think about it this way: like 10% of, or like in this case, 30% of 100 million is better than 100% of a million because you can't manage all of it. It's better to have people that you like, know, and trust because these are different skill sets. These are different types of people. So if you can bring that in, that's going to be extremely helpful. Now, I didn't have anything right here, but this is the thing that I think the most is what gets me investors. One, because there's so much money sitting on the sidelines. It's really easy if you go, hey, and we'll talk about your little pitch or whatever in just a minute, but it's really easy to get people that have money. But what happens is once people get to a certain level of money, they then start going, how can my money make an impact? How can my money start changing the world? And so if you're giving them away, one of the things I say to people is like, hey, your money's going to make money, but your money is also going to change people's lives. People go, oh man, I want to be a part of that thing. So what's the mission that you can attach to your thesis? The thing that you're doing, maybe it's affordable housing. Maybe sure, you're a hedge fund, but maybe you give to a certain, like you give a portion of your profits, or you do certain, you go out and your team volunteers here or does this. Like people want to give to something that's bigger than themselves. And so if you have a mission that you can attach this to, then people start to feel it a little bit different because sure, they're investing into deals. They're already in the S&P 500. They're already here, but now they're at the point where they want to start making an impact. And as Maya Angelou always says, and who I absolutely love, Maya Angelou says, people forget what you do, they'll forget what you say, but they never forget how you made them feel. So if you can make them feel different because what you're doing is different, then changes everything. Changes everything. It really allows people to get on board with what you're doing. So then, let's say some stuff hits the fan. They're still aligned with your mission. They didn't just get in because of the money. They knew, like, and especially if they're accredited investors, they knew that there is an inherent risk to what they're doing, but that a lot of times the impact outweighs the risk. And so you really, really want to align with something. And so just ask yourself, can you pitch your fund in 30 seconds to make it sound credible? If so, you've got a good thesis. You've got a good idea. And we'll talk about your pitch in just a minute and we'll move on. Now, the next part of this is we're going to build it. We got to decide on what we're going to build. Are we going to build a syndication, a fund of funds? And I'll tell you about a little bit of a difference between these. So like, let's say a syndication, right? A syndication is, we're going to go 1-to-1 asset. So we're going to have investor into your fund, and that's going to go into one asset. When you have a fund, you now can go into different things that fit into your thesis. So for instance, I could say, right, single family house, or I could say residential real estate in the Southeast United States, including single family houses, duplexes, quadplexes, all of that stuff. And then I'm not limited to just one asset. As long as it's in my thesis, as long as I've disclosed it, I can be able to say, hey, it goes into different things. And then you have the fund of funds. So some of you may be in here and go, well, Devin, I'm not a great operator. And that's okay. You don't have to be a great operator. Like that's totally fine. What ends up happening is you can go, hey guys, I'm going to start a fund, right? I'm going to start a fund. And then you have, maybe you're a doctor, maybe you're somebody, but you got a bunch of investors and you can raise capital from those investors. And you guys say, guys, I'm going to give you 8%, right? I'm going to give you 8% on your money. And I'm going to go and I'm going to find good operators to invest in. You still have a thesis. So maybe you say, I'm going to go find good operators that are investing into multifamily in the Southeast United States. So now you go operator 1, operator 2, operator 3, but then you're able to come in here because you've got 5 million raised. You can come and negotiate with these people and you can say, hey, I want to get in equity, but I also want 15%. Or I want a piece of the equity at the end because I'm coming in with 1.2 mil here. I'm coming in with 800K here. I'm coming in with whatever. And like, you're coming in with a bigger portion. you can be able to, you get better economics because you're coming into these operators and you're investing more. Then what ends up happening is these guys are giving you, right? These guys are giving you, let's just say you end up making, heck, 15 to 17% on your money. Wow, these numbers are whack right here. I don't know what this is, but you make the delta because, and then maybe you're even doing like a 2 and 20 with these people. So whatever, there's so many things you can form this, but now you're getting the delta between 8 and 17 equals 9%. So now you're getting 9% on this 5 million. And let's say if we do the math, right? 9% on 5 million is, I don't know. How much is that? 5 million times 9%. You're now making 400. Yeah, that's right. You're making 450K just because you're deploying, you're giving them their money at 8%, and then you're deploying it, and then you're getting really good returns. So all you're doing is finding good operators. You got friends, you pull them together, and then you're finding good operators to invest in. So that's what a fund to fund is. Fund to funds have gotten extremely popular, and I think they're really great models too. So would highly suggest that if that's where you're at, you're not an operator, but you feel like you can still go out and raise capital, would highly suggest that. Okay. No questions. Sweet. I can't believe you guys don't have any questions. Shoot, I hope you guys are taking good notes here. All right, now let's go ahead and start talking through like, what are the different things you have to, if you're going to build it. So we got to go, okay, we're going to go syndication. We're going to go to a fund. We're going to go fund to funds. So let's say we're going with a fund here. Then there's different types of funds that we go, all right, there are different regulations. So these are different exemptions with the IRS. Now, some of these exemptions, if you go with them, they have different rules and stipulations that you have to abide by. So they just look different. Sometimes they have different requirements or different things that they allow. So for instance, like if you go with a Reg D, which is 90% of people are going to be a Reg D fund. So let's bring that in here. 90% of people are Reg Ds. And you go, all right, is it going to be Reg D 506B or 506C? So let's talk about this, okay? Let's dive in. I actually have another graph right here for you guys. This is the biggest, and let me just go through these real quick so we don't have to come back up. Reg CF is like I like to think Reg crowdfunding, right? So when you think of like Grant Cardone, who's going out and going, I have 50,000 investors in my fund. It's way more expensive. It's probably like 100K to start a Reg CF, but it allows you to raise up to 5 million. And then what ends up happening is it allows you to take in smaller check sizes that are like 5,000, whatever. But then also he may be a Reg A, but probably not. But Reg A is if, let's say, like it's like a mini IPO. It allows you to kind of go public and not have to have a lot of the regulations. It's a little bit more liquid. You have the ability to be able to take up to 75 million a year, depending on your tier, and from non-accredited investors, publicly solicit, all of those things. It just requires a lot more auditing. And then, of course, you've got like offshore offerings and then qualified institutional buyers that come in. So like it just, there's different exemptions, but you most likely will be a Reg D, and you'll either be a Reg D, 506B, or 506C. So let's talk about what that means. A 506, the biggest thing here is it's going to be your what's called solicitation. Can you talk about your fund on social media to the public, to the world? Can you talk about it? And if you are a Reg D, 506B, you are allowed to have non-accredited investors, which I use this. When I think of accredited and non-accredited investors, I think of 1, 2, 3. So accredited investors have $1 million, 1 million net worth outside of their primary residence. If they have 1 million net worth outside of their primary residence, they are a accredited investor. Man, that looks trash. 2, they either make 200K a year per year individually for the past 2 years and for the foreseeable future, or 300K a year jointly with their spouse for the past 2 years for the foreseeable future. So that's where I say 1, 2, 3. If they are either any one of these 3, they are an accredited investor. If they are not, they are a non-accredited investor. And what this is just this just happened because when the SEC came in, They didn't want people scamming grandmas out of their life savings because they could solicit to anybody, and grandma sees an ad and she loves the ad and she wants to invest her life savings, but she does not have the ability to lose her life savings. Or she's not a savvy investor to be able to tell the difference. And so then what ends up happening is the SEC said, okay, we're going to separate them between a 506B and a 506C. Only 35 non-accredited investors are allowed to invest into 506Bs to limit the liability. But then you can have as many non-accredited investors in there as you would like. So, as many accredited investors as you would like. And so this is really good for like referrals, for friends, for things like that. But the biggest thing is here, you have to have a pre-existing relationship. Now, some people go, what the heck does that mean? Some people will say pre-existing the offering, a relationship that pre-existed before you started the fund. Or some people would say like the IRS is so gray here that like, oh, as long as I have a calendar set for when I first met them, I put that on my calendar. Hey, I met John Doe on this day, on day 31. We went out to coffee on day 4. We went out and we hung out. I gave them some information on what we're doing, but not on the fund specifically. Then 2 weeks later, 3 weeks later, we hung out. 30 days later, who the heck knows? We hung out again. And then I told them about my fund, but I cannot tell them about my fund before having a pre-existing relationship. Pre-existing is fairly subjective, but I can't have that conversation or raise capital from them without having a pre-existing relationship. Whereas a 506C, it has a little bit, it says, hey, I can publicly advertise and I can put it on my website where people can then just come in and subscribe that same exact day, right then and there. The only bad thing is they've got to verify it. And I'm not allowed any non-accredited investors. I can only have accredited investors in my fund, only accredited investors. And so then they have to come through that. The verification process is a little bit longer. So you want to work with people that fix that or take care of that for you, companies that take care of that for you, which I might tell you about one later, but take care of that accredited, because like they have to get a letter from their CPA. They have to get, they have to show either tax statements or things like that. It's better to just go through like a lawyer or a CPA, get that accreditation, or they upload their taxes and their net, things like that into the accreditation process. So thinking about this, as you're forming this, you go, all right, I'm going to build a fund. This is going to be my thesis, right? Like, so we've talked about the thesis of it. This is my thesis. This is my team. And we're going to allow accredited investors only. So we're going to be a Reg D 506B fund. And then now let's talk about how your investors are paid, because this is the important part. As we're designing, excuse me, as we're building out our offering. We're building out what we're going to be pitching to people and what they're going to see and understand. We go, all right. If we're, sorry, my dog is just eating something. If we're beating out this offering, are we going to allow people to take profits, or is this going to be just straight debt? So let's talk about this debt idea. Just debt. Debt is ideal, right? Like you want it to be just debt, but if people are lending, they want a part of the upside. If they're lending to you for like 1, 5, or if they're lending to you for like 5, 7, 10 years, they want to be a part of the upside unless they want something just super stable. So if you're going to open up just a debt fund, then you're probably going to just have like a fixed rate. So you're going to hear things like words like pref, right? Pref, this is a preferred return. So what happens is when you are raising capital and deploying it and then getting it back, you participate in what's called a capital stack, right? The capital stack is, let's say here, right? We have the capital stack is debt gets paid, right? Once the debt gets paid, it then goes down to starting to pay returns. And the people who have pref returns, right? So you've got preferred returns, and then you've got you're down at the bottom. But your people who get preferred returns, they are paid first. So they get their 8% before you get to take your profits at all. So if you want to say, hey, fixed rate of 8, fixed rate of 10, fixed rate of 6, whatever, they get their pref of that, but that's all they get. They're not guaranteed. Nothing is guaranteed, but they get that before you get to participate in anything else. So this is owed even if you underperform. There's no upside potential. Like this still comes in, and then you don't get anything. So like, think about it. If you only provide 5% return that year, then like you don't get any of that. They do. It's easier to underwrite because you know exactly what it's going to be, and it's short-term capital. It's great for short-term capital. So you can turn this over a couple times, and you're going to be doing this. Like, let's say if you lend out at 12, you want to start a lending fund, you're going to lend out at 12%. You make the delta. Now, here's equity investors. This is where you come into the typical 2 and 20 model. We're going to talk about that next, literally next. But this is actually, we can talk about this right now. So the 2 and 20 model is how a lot of people in private equity or hedge funds perform. The reason why this is so popular is because they go, we're going to put all the money up front. Hold on, give me a second. Let me erase this. I meant to put 20. So 2 and 20. We're going to put the most money up front. So then we expect the most upside. Your investors, so you make the 2 and 20, your investors are making 80% right here because they're putting in all the money for you to participate in the upside. This is typically how it goes. This is like how BlackRock and these bigger companies scales because they're giving away upside, but they are doing it at high magnitudes of scale. So when you think of, right, and we'll talk about this in a minute, when you think of 100 million at 2%, right, that's $2 million that you're making just for managing the money. And it's the same work or the same thesis if you're like a hedge fund or something like that, as if you were just managing $2 million. So the pros are it aligns interest. They know that your skin is going to get, you want to get to like certain hurdles so that you make more if we talk about that, but you still get paid less. And there's a little bit more complexity because of the math of it. Now, let's talk about a waterfall because this typically falls into what's called like a waterfall structure. So taking notes, you guys are still here. You're tracking with me. Fantastic. I still don't see any questions in the chat. So I'm just going to pretend like you guys are the smartest people to ever come onto a live that I've ever seen in my life. Let me see if there's like anywhere else I can see notes. I can see anything. No chat, live stream chat. Nope. Nothing on the live stream chat. Nothing on the chat. Okay, cool. All right. So let's go back then. So if we are right, we're doing, this is what's called a waterfall structure. So let's say, for example, 100 million goes into here, right? So like, let's change up the color here to not be black. Let's change this thing to bright green. Okay, so let's say that this is a $10 million fund. You raise $10 million into your fund. What ends up happening is your profits end up waterfalling, right? Just as it's called, waterfalling in. And as it reaches certain heights, your pref is paid out. But once you hit your pref, and so this is where some people do either a catch up or or they do their management fee. So a management fee, just to give you guys an idea, a management fee would actually be right down here. So your 2% would come in and you would get your 2% as people invested. So let me just take that out right there. You get your 2% as people invest, and then they get their pref. Typically, like if you've got a track record, you've been either a longer lasting fund, or you've done this a couple times, you've got really good experience with these investors, they trust you, they're fine with you taking 2% off the front end to get your management fee. If you're a newer fund, you probably want to do what's called a catch up, which goes, hey, they get their 8%, and then you catch up, you get the splash here, you get the 2% here. And then what happens on top of that is what's called carried interest. Now, this is very advantageous to you as a fund manager. And this is why fund managers are some of the richest people in the world, because this 2% and this 8% is all taxed at an income-based level, which is what, 40 to 50%, right? So like that comes in, you get that money, that's taxed at 40, 50%. But because we are a capitalistic country and we have presidents that really like funds and fund managers and investing into America, your carried interest is actually taxed at a capital gains level. So now so then the majority of what you make, the majority of what your investors make, then is only, what in the world? All right. The majority of what you make and what your investors make is, whoa, I don't like that. I must be. Okay, there we go. The majority of what you make and what you make is taxed at what is it, 15 to 19% capital gains level. So you are literally saving 20 to 30% in taxes on the majority of the money. So like, I just want to do some math right here. Like, let's just break down some math here. So let's say you got a $10 million fund. The management fee or the catch up is $200,000. So that's nice. So you've got 10 million AUM in here in just cash. 200,000 is what you're going to make from managing that money. Then what happens with the carried interest? So let's say the fund earns $4 million. So now you're operating at what, like, so on top of everything, so $14 million AUM, because you made 4 million in profit. You got 10 million, and you want to give those preferred returns so your investors get their prefs, right? So on 10 million, 8% of 10 million is $800,000. So 800K goes to investors right off the bat. So that's 800K. But 800K, you're still left with about $3 million that has to be split up. And so if they're getting 80% of that, 3 million, actually it's 3.2 million, but anyways, so they're getting $2.4 million is their return, right? 2.4 million more dollars on that $10 million that they invested, and you get 600,000. Now here's the thing that I love. One investor isn't making 2.4 million, right? Like, one investor isn't making that. It's spread what's called pro rata, or in correlation to how many shares of ownership each member has. They get a piece of this $2.4 million pie individually. But you ain't splitting this with anybody. This is your 600,000. And so it just scales proportionately. If you make more money, then you get more of that. It scales proportionately. And so their total returns ends up being, right, total returns on $10 million is 3.36 million. So let's see what that is. 336. Actually, that's 36. That's 33.6%. So they're making 33.6% return on their money. They're happy, and this is because of the waterfall structure here. And so that's why this is such an advantageous. Sure, you could go 8% pref and then just do that, but you're going to get far more people, if you can be able to do something like this and generate enough alpha and profit into whatever you're doing to start splitting this. You're going to have 100, 200, 300 people investing into your fund rather than 30, 40, 50, 60, because you're just an 8% pref. People want to participate in this upside. And on top of that, if you have real estate, then also that depreciation is passed through to your investors because they own equity into the fund. Crazy, right? This is the most lucrative business in the world because of this. Now, here's how the money works. So some people go, okay, well, how does that work? How does that work? Okay. So let's talk about this. Your investors are investing capital, right? Boom. The capital goes into the LP, the limited partnership right here, which is the fund. So you've got investor capital, investor capital, investor capital. It comes in, and then the fund go ahead and invests into the deal, right? So money is going into the deal. It's the operator is managing it. The operator is good. So then what ends up happening is then boom, profits then go back up into here. And then from there, you get your management fee, right? So like in this case, if you're doing a management fee, then it's going to go boom, 2% here first, and then over here. So you get your management fee, and then it goes in there. But if you're doing a catch up, profits go up here, and then profits are split 2% here, 2% here, and then the 8% pref, right? So then they get their 8% pref, and then 20% here, 80% as more profits come in. Gosh, I hope that was, you guys understood that. Money comes down into the fund distributes it into the deal. The profits go up into the fund. The fund then pushes it out to the management company, which is you, and then the investors, the GPs get this, the LPs get this. Hopefully, please stop me if you need me. Keep going. Okay. So now, a lot of this stuff is like, okay, this is great. The things that you could use AI on, I will 100% say, like, you can use AI on honing in your thesis. Sure, you could do that. You could use AI for the underwriting. You could use it for all of that stuff. The biggest thing that you guys are going to use AI on is when it comes to here, raising the capital, being able to create the content, being able to put that out there, and then even like organizing and managing it and finding new investors and different things like that. So you guys got one, we talk about like your investor funnel, right? So like cold, curious, educated, soft commits, wired. We really want to be able to get out there. A lot of things that I do is social media. I use social media a ton to find investors, and I don't just like share what we're doing. I share exactly like, hey, this is what we're doing, who we're impacting, why we're doing it. The more they could do that, the more curious they become. Now, this is where I bring in my elevator pitch, and I love this. This is like my favorite thing to do. When people ask me what I do, I don't say what, like, as far as like an operator, I don't say like, oh, we fix and flip residential real estate in the southeast of the United States. Like, I don't tell people that. I say, hey, we I help people passively I help people earn 10%. Actually, I help people earn double digits by passively investing into deeply discounted real estate. And then I'll get people that go, oh, that's cool. And then I get people who go, oh, tell me more. Oh, I've been really interested in investing into real estate. Oh, this and that. Those are my people. The people that say, oh, okay, that's cool. They're like, sure, cool, awesome. That's what I do. But the people that go, tell me more, I'm like, gotcha. Those are my people, right? I've got them curious, and then I begin educating them. I go, oh, this is what I do. Let me walk you through this. Actually, this is something either like a lot of times people will then push them into a webinar. And so we actually use AI to completely automate this process. This is all automated, baby, right? So you get them in. Now you've given them some sort of freebie. You've given them some sort of book. You're giving them something that's giving them value. And then you're giving them, like, you're staying top of mind because now we've got them into an email sequence. We've got them into a process that then tells them about who you are, builds the like, trust, knowability factor, helps them to see like, oh, this is what you're doing. This is how you're doing it. But I'm not specifically telling them about my fund or anything like that unless they're asking that question, but I'm educating them. I'm building trust. And then what ends up happening is I'm following up with them and then soft committing. Now there's ways that we're going to talk about how to like predict this, but I've got this whole process, right? Like you network, you engage, you partner, you build connections with your brand visibility, right? So we're networking, we're going places, we're getting in the same rooms as them, we're joining masterminds, we're joining golf clubs. Like golf clubs, sure, I've heard that they don't work as well, but for me, I'm in the places where my investors are. I am spending money to get into these rooms. I am taking people and paying for floors. Not, I haven't paid for floor seats, but like box seats and things like that, bringing them to those things so I can have those conversations with them. I'm engaging with them. I'm constantly following up, giving value. This is a good Gary V jab, 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 right hook, but still asking them, what are you investing in? What do you not like about what you're currently investing in? What are you frustrated with your investments? Man, this sucks that, you know, like they'll tell you all of these things. And then you go, okay, well, this is cool. I'm going to send you something that I'm doing. And so then we start beginning to enter into that partnership level. And so, of course, you've got the ladder. We climb the ladder of awareness, who we are. They see us on social. They see us on podcasts. And I encourage you to find what medium works well for you and then push them to educating, learning more about what you're doing, how they can invest into it, sharing stories about what other investors are doing, and then begin having the conversations that puts them into soft commits and verbals. This is then what helps you so that once you actually launch your fund, once you have your docs together, they then can wire the money in. But right now, we haven't even put together docs yet. Right? We haven't even put those docs together because we want to see who's actually interested and if you should like start a fund like this or not. Because if not, don't do it. You'll just be wasting a bunch of money. But if you can have the conversations and you start getting people that's interested, then like get your docs. Because what ends up happening is, and I got some more. I got some more here. Where are we at? Oh, this is my first framework. It's over here. Well, I'll get to that later. Because then what happens is now that you've got proof of concept, you have raised, you've got soft commitments, you've began doing that, then we can start launching, right? We got launching. We have, there's certain sets of docs that you guys need. You need a PPM, which is your private placement memorandum. This is like 70 to 100 pages of risks, right? Like it's like 100 pages of documents of your thesis, who you are, what you do, what your team is, and then like 60 pages of disclaimers and risk. And I often joke with people, I'm like, hey, there's gonna be 60 pages in there to try to talk you out of doing this. And it's just gonna tell you that you're gonna lose your house, you're gonna do all these things if this goes sideways. But don't worry, unless I get abducted by aliens, that's not happening. So there's an instance where the PPM outlines all of that. And then you have an SA, which is your subscription agreement. So this subscription agreement says how much are they going to commit. They sign this. So they sign your PPM, they sign your subscription agreement that says how much they're going to give you. And then you have like your Form D, which is your filing. So usually the attorney will do that, or somebody like us will do that for you. And then you have your, and then you'll have your operating agreement. So like, how is it going to operate? Who's the management? All of those things are in there. And so now you go legal, live, and you can scale. And so you can work with a form attorney. And then you have things like Blue Sky. Don't worry too much about that stuff. You'll get there once you start actually doing it. But then you want to launch automation with a CRM or an investor portal with onboarding, things like that. And so this is where, like, really cool. I'll show you guys something. There's a couple of programs in which you could do this with. You can launch with, you could do this with. Now, when it comes to, I do want to show you guys I'm going to show you guys like a little ChatGPT hack that I really love. There is a plugin, right? Because like the biggest thing that a lot of this stuff comes down to, as we know, like ChatGPT, is prompting, right? So let's say like prompting is just a big part. I actually found this. This is called Sam the Prompt Creator by AI Advantage. Fantastic. This is not mine. But like literally you could build prompts for everything. So like this builds the prompt for you. I know we have such issues with prompts. So I go, I want a prompt for a capital raising expert copywriter for raising capital for my fund, blah, 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 right? And what I love about this is this is going to go, great, here you go. And then it's actually going to build this prompt out for me. It's going to build a complete system prompt. So look this up, Sam, the prompt creator. It's going to build a full system prompt. Look at this prompt. So I'm not creating this prompt. I don't even own this. I should pay, like, sure, maybe I create one of these and then I charge you guys for this. Whatever, this is free. This allows you to do that. And so then now I've got all of my stuff in here. Or like now this has become a really good thing for me to come and use. And so I just go, sure, I'm going to copy this code and I'm going to create, or once the code is done, it's not done yet. I'm going to create this code because so many times people are going to try to sell you like on their prompt. So like, boom, copy and paste that. And then I'm going to tell it about my thesis. I buy houses in the Southeast US that are deeply discounted. Help me to pitch that. I don't know. Cool. So like it's building out some stuff here. I don't need that. Join that. So then now it actually, I think, is contextualizing to what I do. But now it's going to go, great, headline, turn this into this. Hey, in today's housing market, distressed sellers, foreclosure pressures, and motivated owners create a steady flow of opportunity, right? So like it's creating this for me. All I did was like, I mean, those are barely, that's not even, I didn't do nothing. And so you guys could totally use this, 100% use this. And then one of the things that I also like to make sure that I do, especially with ChatGPT, or you could use Claude. Claude is very, very good with stuff like this, is I want to work in my projects. You see that I've got projects for everything. But if I create a new project, I can also in there, like, right? So I can create a knowledge base. And in that knowledge base, it has, where's my knowledge base in here? So if I create a new project, and I can say SE Fund, I can then come in here and begin uploading my docs into it. I can add files in. And so then it has my docs, it has my PPM, it has all that stuff. So then I can ask it questions about my PPM. I can ask it questions when investors have questions, all these things. I now have a very in-depth, like almost like an assistant or a legal assistant, whatever I've created a prompt up here for now becomes my legal assistant here, or whatever, I mean, literally. So then now I'm going to come in here and paste that prompt in here. Now, whatever I contextualize in here with my, whatever I build out in here with my files gets put into that prompt that I just created here, and it contextualizes all of that. So it's a really good way to kind of stay on topic and make sure that it stays within what you want. So it's been fantastic. I love this. So it's really good to be able to have, because then it makes it so much easier to raise capital or have conversations. Or sometimes people will ask me questions and I'll say, what does this mean? What does that do? Or I'll put out an email. And what I do for a lot of my emails, I've got a questionnaire. So this is actually kind of cool. I'll show you guys my questionnaire that I send to, I'll show you guys this. So I'm at the point in my fund, like especially my first fund that didn't go as like well, I do weekly updates. Not even gonna lie. I do weekly updates because they want to know what's going on with their money, what's all that stuff. And I'm giving them updates every week. So I'm like, hey, here's my closings, here's the contracts. I'm very transparent. Market plan, number of new leads, the cash reserves, debt pay down, do all this. And then what happens is this gets put into a spreadsheet and I copy and paste that spreadsheet. And then a lot of times I put it into ChatGPT and it puts together the whole email from me, just from my entries into the spreadsheet. So then it makes that email for me really good. And all I have to do is go in and answer some questions on the spreadsheet every week. That makes it so much easier for me. Now, a couple of things that I've done. One, I've created, this is really cool. I actually created what I believe. I mean, there's no exaggeration. I think it just is what it is. I've created like the best fund management, capital raising, and if you lend money, lending CRM that there is. Manages all of your investors. Whoa, give me back, log me back in there, Scotty. Go ahead, give me a quick second. Let me log in to the demo account here. So what ends up happening here is I now have, I can come in here. I've got my investors in here. And what's really, really cool, like this is so sick. So this is how like I'm using AI. Oh, where the heck are all my investors? Dang. For some reason, this is the demo account. It doesn't have my investors or the pipeline on here. But one of the things that I really like to do, you know what? Let me don't share real quick, but I'm going to show you guys because this is really cool. Let's do it. Cool. So one of the things that I like. All right. Okay, share. Share. Okay, here we go. One of the things that I like to use now that I'm using a ton of AI with is things like this. So this software that I built is so cool. It could come in and actually even tells you who's likely to be on some of your deals, have the email conversations, even insights where it would actually search the internet on LinkedIn and articles on the internet that match up with this person. It'll do it in your like scheduling. It's really cool. And then also, what deals do I have? And let's say like, okay, cool. I've got this deal here. Who are some investors that are likely to invest in on this deal? And then this is very cool. So like, it's like, okay, this is the deal. These are the investors on it. This is, as I upload the timeline or put something in here, I can go, hey, send them an update. And it's going to go ahead and generate the email. Actually, it's going to, in a second, it's going to give me the prompt. Based on the timeline updates and the notes that I have in here, I can add more notes in here and go, the GC is slow and slowing everything down. We are going to tank on this one. And then I can come here and go, I want to sound pretty direct, and then generate that with AI. And it is literally going to come in and I can send this to just these people right here and then generate a whole email about, hey, I got to make sure that doesn't give me these things. But like, hey, this is where we are on it. Here's some things. The GC has accelerated the work, but I don't know if it's going to do as well. The currently progress, despite previous concerns, the project it's progressive. But like, you know, like it builds out all of this based on some of the stuff I said here. Oh, I didn't spell any of this right, which is probably why I didn't give me what I said in the email, because I didn't spell right. But it's cool because I'm using AI for that. I'm using AI to figure out who's going to be the best, who's going to do this. And so like AI has been crazy. I can even have an AI assistant. I can do my distributions and returns in here. The assistant is right here, and it could be like, hey, help me with the CRM. Help me to view my pipeline, analyze my deals. What are these things that are going to happen in here? And so like, it's a really cool thing. It manages my lender loans. So I have like let's say I have private lender. You guys have private lenders for stuff. Here you go here. You can manage the loans. I got to fix that part, of course. But you can manage the loans that you have out with your lenders. It's so cool what you're able to do in there. And so I use AI for that specifically because I built out that program. And so like, it's just been a really cool thing that I have. Now, one of the things that you guys might be like, okay, how does this help me or whatever? Like, let's say you guys are interested, right? Like you guys are interested to the point where you're like, Devin, I'm ready to scale up. I need to scale this thing up. And I want to make sure that, that we're doing things right. Because one, AI can help you with writing your emails, your scripts, your one pagers. It can help you with like your fund avatar, which actually, this is really cool. If you guys go to wearefundfounders.com, fundfounders.com. You can actually build out a whole fund avatar for you guys. It's completely for free. It's going to help you to analyze deals, automate the follow-up, predict things, train. You could train your employees. You could do so many things with it, but it's not going to help you with your docs. It just won't. It won't help you put together your fund. It won't help you to be able to communicate well with other investors, other fund managers, things like that. And so that's kind of where we step in. This is kind of really transparent, and this is what we do. What we do is we help people launch and scale investment funds. So you guys are thinking of doing all of this stuff. Where are we at here? Where is my thing? Is this it? That's not it. Okay, here it is. Perfect. So if you guys are thinking, okay, I want to launch and scale an investment fund, great. You're still going to need the docs, right? So like you'll still need the docs. You'll need the docs here. And then you'll need a group or a community, because I think of all the time of like, how do I do this? I can't do this alone. I need help. You need somebody to handhold you, walk you through building up all of this, walk you through making sure that you're doing it compliantly, legally, but then also giving you the experience of doing it together, sharing deals, doing all that stuff. And so we created our Fund Founders Founder Circle. And so if anybody's interested, please message me. I didn't want this to be like a huge pitch thing, but message me and I will make sure, because this is crazy. I'll tell you right now, like fund docs by themselves. Actually, somebody just sent me something the other day from just an attorney and it was like 12K. Sure. Cool. Like that's great. An attorney's going to do your docs for you for 12K, 12 to 15K. You're going to get that. And that's fantastic. But we have what's called our Fund Founders Founder Circle. I don't have it on a slide right now, but we have our Fund Founders, cycle, Founder Circle. And so what we do is we charge $25,000. And so for $25,000, you guys get your fund docs. You guys get a community of other fund managers in here helping you to be able to launch funds. And some of them are fund-to-fund managers. And remember, we talked about that. Fund-to-fund managers that are going to want to invest into your deals. They've got money to invest into your deals. So those fund-to-fund managers, you'll get weekly coaching with me. So I'm going to help you, me or my partner who's an SEC attorney. We are going to help you walk through things that are going on. Like what the heck is going on in your fund? How are you raising capital? How are we using AI? How are we leveraging these things? How are we building up on these things? And then also we will handhold walking you through your first fund, the documents on it, getting that out to you so that within the next month or two, if you guys are thinking of raising capital, then we're going to handhold walk you through that process. So we try to make it as easy as possible. And so what I'm going to do here really quickly, I'm going to put the link in the comments so that you guys, if you want to, you could click that link and join the Founder Circle. And the Founder Circle is what's really going to be the thing that accelerates you through this process. It's really going to be the thing that helps you to get from zero to launching and scaling your investment fund. It's really going to be the thing that helps you to scale right and correctly and compliantly, because those are the things that I worry about, and I don't want to have to worry about that with you because you're going off and doing it somewhere else. I don't know. So I want to make sure, I'm looking for the link right now. I'm going to drop it in there. And so if any of you guys have questions, I want to be as helpful as I possibly can for you. I want to make sure that we can answer those questions in here. Here it is right here. You guys can go there. It is, whatever portal at wearefundfounders.com. You can go in there. And if you need to, let me know. Like if you're interested and you want a payment plan, we also do instead of just the 25, right? So like if you could go 25,000 now, or we go 4 payments of $8,000. So actually, I think it's 70. I think it's actually 70. I think it's $7,000. Boom. So 4 payments of $7,000 for you guys. So we can either go 25 and we can make sure that we get all of those docs done for you. We do your PPM, we do your filings, we do your LLC formations, all of that stuff taken care of, fast tracked, so that you can go and you can do what you do best. You could go and raise capital compliantly. You can go and manage your fund, or you can go and you can manage and operate your fix and flips, your trading, your whatever you're doing here, where you go buy in other businesses. If you guys are going to buy other businesses, you pull the money together, you're going to need to do something like a fund. And so we want to make sure that you can be able to do that. We want to make sure that you are going to have the skills and the tools that you need to be able to do it quickly, compliantly. And there's a lot of times where people go, maybe I'll do that 5 or 6 months down the road. Like, sure, you could do that. But I always tell people, if you're thinking of launching in 5 or 6 months, then you need to start now. You need to start now, because what's going to happen, right? Like, we're looking at I mean, like, I don't even know what's going to end up happening, but with the economy and all that stuff, like, who the heck knows? But I do know that there's a lot of giant bridge loan on multifamily coming due. You want to get ahead of that. You want to have the capital ready to deploy when that time has come. I do know that if you like Bitcoin or if you like crypto, we're about to enter into a market where I think I think we're in a very bullish time. And over the next 2 to 3 months, 4 months, we are going to see a massive increase on a lot of those things. I do know that we're in what's called the silver tsunami. This is an incredible time to buy businesses, because a lot of people are retiring, and there is the greatest transfer of wealth in human history. And a lot of their kids don't want those businesses. And so what we can do is we can come in and we help you to launch, scale, and fund. Well, we don't raise capital for you because we don't have the licenses for that. We didn't talk about licenses today, but we don't have that for you to be able to do that. But we don't have licenses to be able to raise capital for you, but we can help you launch and scale your fund so that you can begin raising capital today and launching your fund and scaling. So if you guys are interested in that, make sure you guys click on that link. If you guys have questions, you can always hit me up on any kind of social media. You can email me. You can text me if you got my number, whatever. I am so here for you guys. Does anybody have any questions? It doesn't look like anybody has any questions. There are people here, but I don't think anybody has any questions. If not, I'm probably going to go, because I have to go and run and actually help somebody today that wants to learn how to launch a fund. I'm driving out to his office, walking him through this exact same thing. Maybe I'll record it. I'll take it and record it. Whiteboard. You know what? I think that's what I'm going to do. So, but yeah, I will help to, oh, here it is. Boom. I'm going to take this and record with this. So, yes, if you guys have questions, let me know. I want to be as helpful as I possibly can for you guys as you begin your fund founders journey, right? Like, we have a unique opportunity to be able to do something that the richest people in the world do, but also, and the wealthiest people in the world do, but everybody, like, for some reason, people think it's just extremely intimidating and we don't have access to do and can't do. So I want to be able to help to make sure you could do it compliantly, to do it ethically, and to help you to scale it. So make sure you guys reach out to me. Click the link if you guys are interested in joining the Founders Circle. And I'm going to do this every week. There's going to be a different one every single week. If you guys are interested in joining, I will be diving through different subjects. Let me know the subjects. I would love to be as helpful as I can. So thank you guys so much for being here. I need to see some participation next time. I want to see some W's in the chat, things like that, whenever you guys jump on next. So I hope you have a fantastic day. If you guys are interested in the Founders Circle, let me know. I am here for you, and I look forward to serving you at an extremely high level and helping you to build generation by generational wealth, because you are able to leverage other people's money. You are able to leverage capital. You're able to leverage government regulations and all of those things to be able to scale. So thank you. I hope you guys have a fantastic day. If you need me, don't hesitate to let me know. And as I always like to say, to great success and greater impact. Peace.